BlackRock, Goldman Sachs, Fidelity, Franklin Templeton. While everyone was watching meme coins, those giants quietly started putting real funds on blockchain. This is the future of money, and it's called tokenization. Today, I'll break down what it actually means. I'm Johnny Zhang, founder of Premium, over a decade in real estate, more than $2 billion under management. Let me give you the real picture. Why does any of this matter to you? Because traditional finance has real problems. First, access. The best opportunities like private equities, real estate syndications are locked behind high barriers. Minimum entry is $1 million, which keeps 90% of people out. Second is speed. The settlement takes 2 days or longer. Capital sits idle, risks build up. Then is the complexity. Multiple intermediaries, paperwork, and reconciliation. Every layer adds cost. These inefficiencies add up to billions wasted every year. So what is tokenization? Tokenization means representing ownership of a real asset, a bond, a stock, a fund, a building, as a digital token on a blockchain. Think of this like turning a paper deed into a digital share that can be recorded, transferred, and verified instantly. When you hold that token, you're holding a real claim on a real asset. Most of tokens right now have no underlying assets. Value comes from hype. Tokenized assets are the opposite. The value comes from real things underneath. Rents, interest, collaterals, real business in the real world. That's why traditional finance is paying attention to it. So why are the biggest institutions building on blockchain right now? To be more efficient. Settlements that took 2 days can now happen in seconds. The World Economic Forum estimates there are $15 to $20 billion a year in operational savings by using tokenization. Deloitte predicts cross-border cost could drop by 12%, which is over $15 billion saved by 2030. And better collateral management could free up over $100 billion in capital. This isn't a bet or hype. This is infrastructure. BlackRock, $13 trillion under management, launched, built $2.5 billion in assets within a year. 9 blockchains accepted as collateral on Binance. Goldman Sachs and NYB Mellon launched tokenized money market fund infrastructure. The plumbing that makes fund shares transferable and usable as collateral. Franklin Templeton has been running an on-chain money market fund through Benji for years before the hype. Fidelity rolled out a tokenized treasure fund on Ethereum. It's in their SEC filings. Platforms like Gaia and Securitize are enabling this, working with Apollo, KKR, Hamilton Lane, and VanEck. This on those startups experimenting new products. Those are trillion-dollar institutions deploying real capital on-chain. And it's not just Wall Street. Even the Trump family announced the plans to tokenize real estate. Political aside, but the signal is really clear. Tokenization is going mainstream. The US government isn't just allowing this, they're pushing it. In July 2025, the Genius Act became the first federal stablecoin law. The stablecoin issuers must hold the US treasuries as a reserve, which means more demand for American debt, stronger dollar. BIS 21 passed the House, clarifying which regulators handles digital assets. Europe has MiCA. Hong Kong, Singapore, UAE are all building frameworks. The US can't fall behind. The signal is very clear now. Regulations is shifting from enforcement to infrastructure. So how big is this going? McKinsey projects around $2 trillion by 2030. Some estimate can go as high as $16 trillion. These are projections, but the trajectory is clear. So what does this mean for regular people? Tokenization won't guarantee higher returns. It's not a get-rich-quick scheme, but it can offer access. Investments that required $500,000 to $1 million might come in smaller pieces so you can buy it too. And the transparency, ownership recorded on-chain, verifiable and transferable. You can sell anytime. And the efficiency, faster settlements, lower frictions, potentially lower cost. The gates are starting to opening up to retail investors. But I'd be doing you a disservice without mentioning the risk. Number one, liquidity isn't guaranteed. And tokenized doesn't mean there's always a buyer if there's no market demand. Number two, platform risk. So you have to ask yourself, who is the custodian? There can still be scammers out there. Number three, regulations are still evolving in the current political climate. So to conclude everything, tokenization is the future of how money moves. It's about upgrading the rails that traditional finance runs on. The biggest Wall Street institutions are building it. Governments are creating frameworks. For regular investors, it could mean access to what's already always out of reach. Thanks for watching. If this video is helpful, don't forget to subscribe.